Welcome to the Ontario Mortgage and Real Estate Insights podcast, where we cover the daily developments, trends, and regulatory changes affecting the industry. I'm Steve Hamoan, your host for today's episode. Whether you're a real estate professional, a homeowner, or simply interested in the Ontario real estate market, we've got the insights you need to stay informed and make well-informed decisions. Today, we have some very exciting news to kick off our episode. The Municipal Property Assessment Corporation has just released their latest report, and the combined value of Ontario's real estate is now estimated at a staggering $3.14 trillion. That's right, $3.14 trillion. This is a significant increase from last year's tally, which was $42 billion less. Now, you might be wondering, what has driven this substantial increase? One of the key factors has been new construction projects across the province. For example, new construction sites like the one at 407 Dundas Street West in Oakville have contributed to this rise in value. These new builds are not just adding to the housing stock, but are also enhancing the overall real estate market value in Ontario. But it is not just residential properties that are seeing this boost. Commercial real estate has also played a significant role. Areas like Toronto have seen their property values rise to $9.93 billion, according to the report. This is a clear indicator that both residential and commercial sectors are thriving, contributing to the overall growth in the market. For those of you who might be new to the Ontario real estate market, the Municipal Property Assessment Corporation is responsible for assessing and classifying all properties in Ontario. Their assessments are crucial as they determine the property taxes that homeowners and businesses will pay. So, when they release a report like this, it is a big deal. This increase in property value is not just a number, it has real implications for the market. Higher property values can lead to higher property taxes, which can impact both homeowners and businesses. On the flip side, it also means that property owners are seeing an increase in their equity, which can be beneficial if they are looking to sell or refinance. So, what does this mean for you? If you are a homeowner, it is essential to stay informed about these changes, as they can impact your property taxes and the value of your home. For real estate professionals, this is a crucial piece of information that can help guide your clients in making informed decisions. That wraps up our first segment for today. Stay tuned as we dive into more insights and updates in the Ontario real estate market. Up next, we'll be discussing how market volatility could drive some mortgage rates lower and what that means for you. Now, let's turn our attention to an interesting development in the mortgage market. Recent market volatility could actually drive some mortgage rates lower. Yes, you heard that right. Despite the turbulence, there might be a silver lining for those looking to secure a mortgage or renew their existing one. Stock markets around the world recently experienced a global sell-off, largely triggered by weak jobs data in the United States. While stock markets have mostly recovered, this volatility has also impacted the bond market, which is a key factor for determining fixed mortgage rates. The 5-year Government of Canada bond yield, a critical benchmark that lenders use to set their 5-year fixed-rate mortgages, briefly dipped below 3% this week for the first time since last spring. Penelope Graham, a mortgage expert at the comparator site RateHub, points out that the bond market is often seen as a safe haven for investors during times of stock market volatility. When traders flock to bonds, it pushes prices up and yields down. According to Graham, this sets the stage for additional fixed mortgage rate discounts. Fixed rates have already been trending down in recent weeks due to easing in the bond market, which is tied to expectations for the Bank of Canada's rate cuts. With the central bank delivering back-to-back interest rate cuts and keeping the door open for more, bond yields have largely been trending down since May. Currently, the lowest rate on an insured 5-year fixed mortgage on RateHub is 4.29%, a rate not seen since last spring when the housing market saw a brief burst of activity. Graham suggests that we could see additional discounting if bond yields continue to trend lower. Following the Bank of Canada's quarter-point cut in July, many forecasters had anticipated a gradual pace of easing that would bring the benchmark interest rate to around 4% by the end of the year. However, some market watchers now expect the Bank of Canada to accelerate its rate cuts, which could drive bond yields down further and directly impact variable mortgage rates. Benjamin Reitzes, Director of Canadian Rates and Macro Strategist at BMO, noted that markets are currently pricing in an additional 75 basis points of rate cuts from the Bank of Canada this year, and another 75 basis points by mid-2025. BMO has also updated its expectations, now calling for the policy rate to decline by 25 basis points at each of the remaining meetings in 2024, ending the year at 3.75%. CIBC has mirrored this call. Reitzes also pointed out that weakness in the U.S. economy typically has ripple effects in Canada. A weaker U.S. economy is prompting calls for the U.S. Federal Reserve to start cutting interest rates, which in turn sets the stage for more easing from the Bank of Canada. If the U.S. economy continues to soften, it would mean an even weaker outlook for Canada, encouraging further rate cuts from both the Bank of Canada and the Federal Reserve. Canada has its own jobs report due out soon, with fresh inflation data following shortly after. According to Reitzes, any snags in tackling inflation could hold the central bank back from more rate cuts. However, he expects to see more signs of slowness in the labor market and the wider economy, which would pave the way for lower interest rates in the months ahead. Etan Pinsky, a mortgage expert at Pinsky Mortgages in Vancouver, says that when bond yields trend lower, it is the insured mortgages that see rates fall first. Homeowners can get insured mortgages on purchases worth less than $1 million if they have put less than 20% down on the home. It could take anywhere from 2 weeks to 2 months for other fixed rates to react to changes in the bond market. Victor Tran, a mortgage and real estate expert at Rates.ca, added that major lenders are likely to wait until bond yields have stayed lower for some time before changing their posted rates. However, monoline lenders have already adjusted rates by 5 to 10 basis points. Both Tran and Pinsky noted that lenders are currently offering special rates to compete hard for Canadians' mortgages. Pinsky mentioned that he has never seen competition this stiff throughout his career. Whether you are shopping for a new mortgage this fall or renewing into a new term, it is wise to shop around and go back to major lenders to get a lower rate. The initial rate offered is likely not the best one available. Pinsky also mentioned that the majority of clients are currently opting for 3-year fixed-rate mortgages, based on the assumption that interest rates will be lower in 3 years when they come up for renewal. However, he is also recommending some Canadians consider variable-rate mortgages. While variable rates are currently higher than most fixed options, they offer the flexibility to lock into a fixed-rate option at any point. This means you can benefit from each anticipated interest rate cut, and then decide later if you prefer the new fixed-rate offers in the market. Pinsky himself recently renewed one of his mortgages into a variable rate because he believes that fixed rates will decrease in the coming months. He plans to take advantage of lower fixed rates in 3 to 6 months. It is important to remember that not everything is about the rate. Pinsky advises considering other aspects such as penalties for prepayment and breaking the mortgage. It is about features, he says. So, while you might be tempted to go for the lowest rate, make sure to look at the full picture to find the best mortgage option for you. The Bank of Canada now perceives a reduced risk of the housing market overheating, citing ongoing affordability challenges as a significant factor in cooling demand. In its latest summary of deliberations from the July 24th interest rate announcement, the bank highlighted how elevated borrowing costs are tempering housing demand, while still acknowledging ongoing affordability challenges and supply constraints. While declining mortgage rates and higher than expected population growth could add to demand, Governing Council members expressed that this seems less of a concern than previously thought. Concerns had decreased that pent-up demand would lead to a sudden rise in house prices with cuts in the policy interest rate, the summary reads. Housing affordability challenges could have played a greater than expected role in dampening demand. They added that affordability challenges could now cause more people to remain in the rental market, putting upward pressure on rent prices, which have been easing in recent months. The central theme of the discussion centered on balancing the need to manage inflation while also supporting economic growth. Here's what Governing Council members discussed on the topics of inflation, GDP, and the country's labor market. Governing Council discussed positive developments on the inflation front, with headline CPI remaining within the 1% to 3% neutral range since January, while the bank's preferred measures of core inflation have eased meaningfully since April. Members noted that inflation had become less broad-based across goods and services. The share of components growing above 3% was close to its historical average, the summary noted. Overall, members expected core inflation to ease gradually to about 2.5% in the second half of this year and then ease further in 2025. While slowing, economic growth has remained positive, but subdued in the second quarter, driven largely by population growth, the bank noted. On a per capita basis, however, the Bank of Canada acknowledged that GDP appeared to have contracted. The Council expects growth to pick up again in the second half of the year to a rate of 2.25% over the next 2 years. This forecast is largely driven by renewed strength in residential investment and consumption, as well as a boost in exports, the summary read. The Bank of Canada also drew attention to volatile wage growth readings that are sending mixed signals. Overall, however, wage growth remains elevated at around 4%, well above productivity growth, the bank said. The Bank of Canada Governing Council members were in agreement that slack in the labor market is expected to continue to persist as labor force growth outpaces employment growth in the near term. The Council referenced the latest results from the Canadian Survey of Consumer Expectations, which revealed that consumers are increasingly pessimistic about job prospects and more are concerned about potential job losses. At the same time, the bank's Business Outlook survey revealed the number of firms citing labor shortages is now near survey lows. Everything considered, there was a consensus among the bank's governing council that they will be able to continue lowering interest rates if inflation continued to ease in line with the projection. The countervailing forces pushing inflation down and pulling it up meant that progress could be bumpy and there could be setbacks in progress toward the target, the summary notes. Members shared various perspectives on how these factors could evolve over time and what they might mean for the timing of future policy interest rate cuts. Given these uncertainties, they agreed there was no predetermined path for the policy rate, the summary continued. They would take decisions one meeting at a time. Now let's shift gears and talk about the Toronto real estate market. Despite multiple interest rate cuts by the Bank of Canada, Toronto home sales still fell in July. According to a recent report from the Toronto Regional Real Estate Board, home sales in the Greater Toronto Area dropped from 6,213 in June to 5,391 in July. That is about a 1.7% dip on a seasonally adjusted basis. Interestingly, new listings were up year over year by 18.5%, although they edged slightly lower on a seasonally adjusted basis compared to June. Home prices also have not bounced back yet. The composite benchmark price is down by 5% year over year, and the average selling price is down by 0.9% compared to July 2023, hitting $106,617. All segments of the market across the Greater Toronto Area saw price declines year over year. While detached homes only declined by 0.1%, condo prices dropped by 2.2%, semi-detached homes by 3.3%, and townhouses by 3.4%. The only property type that bucked the trend was detached homes in the city of Toronto, which increased just barely by 0.5%. However, there are signs that show a recovery might be on the horizon. Home sales were up 3.3% year over year, and on a seasonally adjusted monthly basis, the average selling price and composite benchmark slightly increased month over month by 0.2% and 0.1% respectively. Sales were up year over year for all property types, except for condos, which dropped by 1%. Sales increased by 8.3% for townhouses, 7.3% for semi-detached homes, and 3.3% for detached homes. Jennifer Pierce, the president of the Toronto Regional Real Estate Board, stated, "We may be starting to see a positive impact from the 2 Bank of Canada rate cuts announced in June and July. Additionally, the cost of borrowing is anticipated to decline further in the coming months. Expect sales to accelerate as buyers benefit from lower monthly mortgage payments." The Bank of Canada announced its first rate cut in 4 years in June, bringing the overnight rate down by 25 basis points to 4.75%. In July, the rate was cut by another 25 basis points to 4.5%. Experts predict a few more rate cuts before the end of 2024, with the overnight rate expected to land at around 4%. Jason Mercer, the chief market analyst at the Toronto Regional Real Estate Board, mentioned that buyers who enter the market in an attempt to take advantage of more affordable mortgage rates in the months ahead will benefit from a buildup of inventory. This will initially keep home prices relatively flat. However, as inventory is absorbed, market conditions will tighten in the absence of a large-scale increase in home completions, ultimately leading to a resumption of price growth, he said. A price forecast from Royal LePage is expecting a year-over-year increase of 10% in the Greater Toronto Area by the fourth quarter of 2024, despite a distinct lack of demand that has persisted in the city over the past year. That wraps up our episode for today. Thank you for tuning into the Ontario Mortgage and Real Estate Insights podcast. I am Steve Hamoen, and I look forward to bringing you more updates and insights in our next episode. Have a great day.